Mel, everybody, I'm Cantonese Cat. Hey, everybody, Cantonese Cat here. I'm going to show a Tom Lee video here with his interview over at CNBC. These videos generally do pretty well for some reason. I think people are just kind of interested in hearing what the narrative says and also hearing kind of my reaction to it. I also particularly like Tom Lee because a lot of the bears out there really do upset me with the things that they say that makes no sense. I am learning my lesson. I've learned my lesson from 2022 that bear markets are real and that you get out of it. And that when you get out of it, generally things look a lot better. And when those things look a lot better, they can look a lot better longer than you expect, especially since you came out from a crash just a couple of years ago. So the way I see it is that it's interesting to hear about all these narratives. It's also interesting to hear the questions they asked Tom Lee as well. Tom Lee is from Fundstrat. He's an extremely smart guy. He goes to CNBC all the time. He's probably one of the only few guys that I can stand on CNBC. But he keeps his composure, even though when people ask him some really dumb questions, I'm just like, ugh, like, what does it even matter? Like, but they keep asking these questions to see what Tom reacts to. He keeps his composure very well. I can totally see if I'm sitting on that chair, I would just kind of like have like this sarcastic grin, and then I would try to answer the question seriously. I do that, but like he just keeps a poker face, just amazing. Let's hear what the interview is like, and we'll kind of comment on it as it goes.
It does take us to our talk of the tape. How much more can stocks rise?
A lot higher, because most of the time, like over the majority of the time, stocks are at all-time highs, and they just keep going higher.
That's Tom Lee. He's Fundstrat's head of research and CNBC contributor, live with us once again at Post 9. Nice to see you.
Great to see you, Scott.
You know, since the Fed did their jumbo cut, the market really hasn't done all that much except for one day last Thursday. Why?
What kind of question is that? I keep talking about this thing over and over again. The market did actually a very, very interesting. Whenever the rate cut happened, the 10-year yield actually has gone up since the rate cut, right? The rate cut has already been happening. I have to keep talking about this because nobody gets it. They always think that the Fed controls the economy. They always think the Fed is the most powerful entity that controls the economy. But they forget that this is still a relatively free market and that the market controls the market for the most part. You have the peak yields on the 10-year and 2-year in October 2023, and it's been plummeted since then. A lot of these things have already been priced in October 2023, and since then it's been plummeting, right? A lot of these things have already been priced in. Look at how crazy the 2-year yield had gone down over the last 5 months, right? Look at the 10-year yield has also gone down a lot too over the last 5 months, right? After it formed a little bit of a lower high here and formed a little bit of a lower low. You have a little bit of like these trees are kind of look to it, a little wick down look to it. So I think that the rates are starting to kind of stabilize. And it's good to actually get the Fed's decision. Like basically rate cuts has already happened. The market's already ahead of it. This is no dispute. Nobody's talking about quantitative tightening either, which is interesting, right? Why is nobody talking about quantitative tightening? Because they're doing quantitative easing already. They've been doing quantitative easing since October 2023 when rates peaked, right? And then since then, you have increase in liquidity being injected into the U.S. system, right? So none of these things are really disputable. A lot of the things the market already priced in. So what are you talking about, man? What are you talking about here?
Well, you know, I think the Fed unleashed us on an easing cycle, and that's going to be positive. We know it's actually historically positive 3 months, 6 months out. But what stocks do in the next month is a bit of a coin flip, and I think that's what we're seeing because there's some repositioning that took place. And also we're now thinking about the 40 days into the election.
So does...
I think that's a fair thing, you know, whenever the market actually is pricing in that it may not have done so before, was that the rate cut has really solidified the inversion of the 2-year and the 10-year. The 2-year has been above the 10-year for quite some time, and it finally got uninverted. Then the 10-year finally ended up picking up steam and actually ended up outperforming the 2-year here a little bit. That is the market trying to digest what is potentially going to happen. And he's totally right. It could take up to a few months for things to really play out. But the thing about it is that when you're asking about like when this happened, when a nerd happens, what do you expect? Why didn't it play out like this week? Why didn't it play out like next week? The market does that all the time. You have people who buy the rumor, sell the news. You have people who sell the rumor, buy the news. You have people who buy the rumor, buy the news. You have people who sell the rumor, sell the news. You can do whatever you want to do, and you use whatever narrative to justify price action. But price action is price action. Real market condition is real market conditions, and increasing liquidity is increasing liquidity. Like, there's really not much else to kind of comprehend or trying to understand. It's actually not that complicated unless if you try to make things too complicated.
The fact that the election is but 40 days away sort of ruin the perfect scenario for stocks to get that post-Fed bump?
I think it delays it, just because in the conferences that I've been speaking at and seeing wealth managers and family offices, a lot don't want to commit capital until after election day, and I don't think it matters who wins. It's just they want to get that event behind them.
Oh, so you think we're going to have sort of a dash to the finish after election day is out of the way?
Yeah, and that's pretty typical.
It's pretty typical that when you have the stock market just on its way up, and this is the monthly chart, S&P 500. This is the SPY. We have the market on its way up for about 5 months in a row. Yeah, and people get worried about the election. So, September, a lot of people are thinking it's going to be September bear. There's only really one more trading day this September, and so far the candle is greened. So, what are these people waiting for? They're waiting for what? Like, are they waiting for more liquidity being injected? Like, are they waiting for real market conditions to drop rates down even lower? Or are they waiting for some kind of narrative because they are told that they're supposed to be scared, instead of actually looking at data and instead of actually looking at the charts to see where money's going to, looking at the trend in terms of where money's going to? What are they waiting for? Are they waiting for the election results because they think certain president or certain political party is going to do a lot better? I honestly think that the market, they don't really care. A lot of times they just care about certainty. They just want somebody to win. Like, it's to me, it's like, I don't know why they do that, but this is exactly the kind of thing that the fund managers are talking behind the scenes. Like, that's exactly the kind of stuff they're like, oh no, we gotta wait for election. Oh no, like, you don't know what's gonna happen. Like, it's really funny to me.
In fact, in election years, the November, December rallies are pretty tremendous. And in fact, when markets are up more than 10% in the first half, you also get big rallies November, December, sort of choppy through September.
Do you think investors are sold on the idea that this economy is going to make it? It's going to make it through. The Fed's going to pull this off. Is any of what we've witnessed since Fed Day doubts about the bigger picture?
Please tell me that they are in doubt. Please tell me that they're in doubt. I need them to be in doubt so stock can go higher.
So far, so good. This Friday, we get core PCE, and hopefully that confirms inflation is no longer on the front burner. But I'd say one thing I've noticed is that the number of investors and professional money managers that think we're already in a recession is very high. And so I think the evidence just has to be better than expected, and I think those views shift back to soft landing.
When we've seen, recently targets for the S&P, Brian Belsky, I keep bringing him up because he's the most recent to raise his target up to the highest now on the street. I've asked you about, the market lately. You haven't sounded like you'd be raising your own target to a degree like that, would you?
I think there is a lot of upside in the foreseeable future. Let's say 3-6 months out. But for someone to tactically say we need to pin a 6,000 target and then put money to work today, I think it's harder to make that case because valuations aren't on the cheaper end, and we've already had a fairly sizable move. So I'm not saying I'm like bearish right now, but to me, I'd have a lot more confidence saying 3-6 months out things are attractive, especially things like margin debt, right? It actually decreased in August, meaning investors have been deleveraging. It hasn't
Aha.
gone anywhere for the
Yes.
last 4 months at a time when markets are rising.
I guess
It's very important to understand that the stock market can only go up when there's not much margin left, because if you have too much leverage, generally there is a need for deleveraging, right? Whenever you have something that is as insane as the dot-com bubble, where if you look at the 6 month, and I'm going to keep showing you the same thing over and over and over again because I keep seeing the same thing over and over again in history. Whenever you have, I'm going to turn this off here, whenever you have the Bollinger Band being so stretched out from the dot-com bubble that happened all the way from 1995 to 1999, went on for about 5 years, you have about 9 or 10 candles. These are, mind you, these are 6 month candles. You have about 9 or 10 6 month candles that are closed about the upper Bollinger Band. You're asking for a correction. Things are just way over leveraged. You're asking for a correction, and it happened. It came, and it got like six, consecutive candles here. Was that enough? Well, people thought it was, but the amount of euphoria and the amount of leverage has just simply shifted from the large cap tech stocks to the small caps and to the financials and to housing. And that also needed to be deleveraged as well, which is what happened during the great financial crisis. What did we just have in 2022 or 2021? We have these 3 consecutive 6 month candles that are way outside the upper Bollinger Band and that needed to be deleveraged, right? So far it's being deleveraged. Right now we're not that overextended, and I think that in general on a bull market, and it's always been a bull market, in general in a bull market it likes to ride up along a expanding upper Bollinger Band, and that's exactly kind of what it's doing right now. It's not really too overextended like it was over here, like it was during the dot-com bubble. It's not, right? So I think that it's important to understand that margin debt being low is a good thing. It's a very good thing. Now, we're talking about people who like, and Tom Lee, I just want to say, like, he puts on record saying that he's more bullish on IWM than he's on large caps, and there are good reasons for that. I think he's cautious when it comes to large caps because he's not wrong. The valuation is overstretched. He's not wrong at all, but there's just a lot of like relative underperformance when it comes to small caps versus large caps, that there is a potential for derotation to happen, right? And derotation can happen for years. For years. And the reason why I say that is because back in the days, whenever you had the dot-com bubble bursted, Russell 2000 and small caps actually did a lot better. I just told you they're rotating from these large cap stuff to like small caps, financials, and to the housing sector, right? So you end up having Russell 2000 outperforming the SPY for the SP 500 for like a whole decade and a half, until it got to the point that it's just like so unsustainable. Like, oh, small cap just going to make you money, right? Is it always going to be the case? I don't know. Just pile in a small cap, over leverage it. So what happens is you're going to get the trend exhausted here with the Russell 2000 over S&P 500 chart, or small cap over large cap chart. And the trend got exhausted, and that's exactly when it started to roll over the next decade and a half, to the point that like people think that small caps, they don't make you any money at all. They're just going to lose you money. If you want to invest in something, buy large caps. But the thing is that large caps are having their valuation stretched a little bit far, and the small caps have not. And you're having a bearish divergence over here back in around 2006 2010. You have a bearish divergence that end up building up and significant outperformance of large caps over small caps for about a decade and a half. Now you're starting to build up a lot of bullish divergence over the last 4 years. That could potentially set up the reverse. That could potentially set up a situation where we're going to end up actually having small caps outperforming large caps now. If that's the case, things actually would look very, very bullish. I just wanted to kind of bring that up.
I guess my point would be, it would have been better articulated to just say, you don't sound as bullish as you usually are. Is that fair?
Yes, I'm bullish into year end, but I'm a little less confident about how markets behave into election day. And not that I think we're going to have a huge drawdown. If we do have a big drawdown, I'd be buying that dip. But I also don't think we can make new highs and then see the market blast off after election day. So I'd rather sort of say things look a lot better after election day.
Can we make new highs if tech doesn't resume its leadership role in anywhere close to the degree that it had?
As long as tech is a market perform. If tech actually declines, that's going to be hard for the rest of the S&P 500 to compensate. But what we've seen so far, including days like NVIDIA and Tesla recently, is that tech is actually holding its own, but other stocks are starting to show catalysts and signs of life.
Yeah. What about the broadening trade? I mean, look, you look at the Russell, your big call, of course. Week to date's down more than 1%. Really hasn't done much at all. I kept hearing, hey.
Week to date, down 1%. It hasn't really done much at all. When Tom Lee has a horizon of like months to years.
You gotta wait till the Fed cuts. Then you go into the Russell. I don't know. What do you think?
When is the time to get into a Russell? Are you waiting for the Fed to cut? Or are you waiting for the US liquidity to bottom? So you know that there's increase in liquidity in the system. Are you waiting for quantitative tightening to end so you know you have increase in liquidity in the system, which the quantitative tightening ended up bottoming in October 2023, right? Again, you look at yields, you look at rates. Yeah, rate cuts, small caps, right? When did it top? Around October 2023 for both the 2-year and the 10-year, right? Where did IWM bottom? Where did the Russell 2000 bottom? October 2023, right? And it already had made a move since over the last year, all the way from like the 160 something, right, at the bottom over here, to the peak around 228. That's a huge, monstrous move. So what the heck are these people talking about?
Well, Russell had a big week last week. It's some profit taking now, but I think that there's, this is what bottoms look like. I don't think bottoms are straight up. I know in 2021 energy was bottoming, and it was also very choppy, but eventually made not only new highs, but then basically had a blistering gain in 2020 in the year following. So I think that's a multi-year start for the Russell. It feels choppy, but we're still near all-time highs, and there's a big fundamental case to own small caps.
Some have made.
It's important to understand the horizon. Tom Lee has a horizon from months to years, and I see the same thing, which is crazy. Because Tom Lee gets ridiculed sometimes as being too bullish, I don't care if I get ridiculed. I just want to be on the right side of the trade.
The case that there are a lot of areas of the market that are overcrowded at this point. So many different sectors have gone up a bunch. You look at industrials and utilities and other things that have traded near or at highs. Therefore, they find better value in bonds. What do you think?
I think a bond investor is buying a bond for a different reason than buying an equity. Because an equity gives you not only inflation protection and benefit from falling yields, but also capital appreciation and positive surprise. Bonds rarely give you positive surprise. I think a bond investor someone should have some income with some capital upside there, but there are so many good opportunities. And, the fact that China has started to actually perform better and potentially broken out, that's again a Brent signal, because that's been a big drag for the last few years.
Oh, how about that? Do you feel?
I'll never own bonds. I would probably never own bonds unless if I really just don't want to take any risk at all. And even bonds are risky. Like, for example, looking at the 20-year treasury bond, right? You have had such huge leverage that had happened that built up for about 20 years. You have banks just kind of leveraging all into bonds. that it can be deleveraged, and even the TLT can go all the way from like 180 to like 80. Like it's like a 60% move down. I If you're buying bonds, I guess it's okay. But even the TLT right now is at resistance. Like there's no doubt about it. You see these wicks up here about it's basically trying to hit this horizontal zone over here, right? And it's hitting resistance right now. Got a little bit of Adam and Eve bottom to it. Sure, it could go up, but I don't know whether or not banks are going to end up over leveraging on these bonds anymore. I don't know if it's going to keep making like a big move, like doubling up over the last 20 years. This is not usual for bonds to do. So I'm just not sure whether or not that's something that's even should be considered for my purposes.
Like the move that happened in China this week's a game changer on how we should view what the potential turn in their economy means for the overall markets. I mean, we've seen certain stocks get a nice boost. Some of the luxury goods companies, right? LVMH, Estee Lauder, etc.
And the gaming stocks.
What about in the bigger picture?
It's hard to tell what's a trading rally versus a bottom for China. I spent some time talking to Mark Newton, our technical strategist. He thinks this is a bona fide breakout. And it is coming on the heels of not only stimulus, but in the face of unrelenting bad news for China. So to me, a rally on bad news is a sign that maybe the worst is already priced into China, and that means it could rally for a while.
I love Tom Lee so much. I love Tom Lee so much. I can't even say anything bad about him. Rallying on bad news is good news for the stock market. That is absolutely correct. Anyway, thank you so much for listening. Have a good one. Bye.